Good day, everybody. This is Jim Kinney, and this is the Option Professor weekly market update for October the 26th, 2018. By way of introduction, I'm Jim Kinney. I provide the content for the Option Professor, and I'm a graduate of Boston College, and I have been in the investment arena here for over 30 years. I've educated people, thousands of people worldwide at my live seminars throughout the decades, and I've helped thousands of people educate themselves on the uses and the risks of options. I am going to today give you my opinions and my views. And as always, I say to you that remember, past performance is not necessarily indicative of future results, and that short-term trading, option trading does involve risk and is not right for everybody. So do find out from your financial clearing firm and advisor and yourself if and what might be suitable for yourself. Okay. All right. Let's get into it today. Again, we've had quite the week, actually a couple of weeks back, up, down, up, down. And now today on Friday, it's been hit pretty hard. And the two culprits really are Amazon and Alphabet, which is Google. They came out with earnings last night, and what happened there was they guided not so well for the foreseeable future in Q4 as far as Amazon's concerned. And of course, when you have valuations and PE ratios on Amazon where they are, you cannot give anything but very rosy forecasts to keep that valuation going. I noticed that Walmart's about a third of Amazon's at one point, yet the revenue to Walmart was twice what Amazon's revenue is. So that told me right off the bat that you've got a very highly valued stock there with PE ratios well into the 3 digits. And if you don't give people a tremendous amount of positivity with your forecasts, et cetera, you're going to have some problems. The other thing with Amazon that if you've been listening to my broadcast, when we hit over 2,000, I brought it to everybody's attention that the moving average on the 200-day was down at 1,500 and change. No way are you going to stay 500 points above your moving average, in my view, very long. And I did suggest to everyone to investigate the concept of collars, where you sell an out-of-the-money call and buy a put, and or a married put to protect that value. Had you done that, you'd be a lot happier today because we're down $155 as I speak, and we have been down as much as $175 today. And so obviously the move from 2050 to 1626 has been quite dramatic. Now we're down either through or towards the 200-day average. So obviously that overbought condition versus that has been offset a bit. There should be some support at some former highs around 1600, and it did bounce from 1603, today's low, to 1626. So there is going to be, again, they did have record profits. That's not the problem. The problem is when you're valued like they are, and I just gave you a good example between Walmart and Amazon as far as valuation. You are going to have to really tell people that things are sunny and they're going to remain sunny. And when they said that there could be a 5% drop in revenue in Q4, which is the holiday season, which is supposed to be a real crusher, a real slam dunk, that's going to get people a little bit nervous with valuations like you've got. So obviously still a great company and still a situation that you might want to own it on the drop here. But the point being is that they definitely took the bloom off the rose, and that's why you got slammed like this. Again, getting back to what I was talking about, if you listen to this broadcast, I brought it to your attention. And again, you've got to buy your raincoats when it's sunny out, because right now it's teeming rain, and those raincoats cost a lot more, right? Okay. Google, on the other hand, I think a lot of it has to do with regulatory concerns. Facebook's, what are they doing with the data, right? And what are they going to do with the data regarding AI and other stuff like that? So I think it's a situation there where people are just concerned that regulatory risk is quite high there, and it has not been priced into the stock. They also are, not exactly knocking the ball off the cover as far as what they think the future is as far as growth and earnings and all that kind of stuff. So those are the two culprits today. Who will be the culprits tomorrow? But here's the problem. The leaders were the FANG stocks, and the FANG stocks are getting nailed. So it's kind of like when your best shooters are not hitting the rim on their shots, it's hard for the team to win the game, right? And so if we're not going to get the big shooters, which are the FANG stocks, back on the bicycle and going up, then I think the market on the overall S&P, because these things are all, you can look at any ETF that has the S&P 500, and at the top of the list are these stocks. They're generally in the top 10, particularly Google and Amazon. Netflix, let's see what that's doing today. Again, a very high flyer. The high flying PE ratios are the ones that are in some trouble, because you're not at 425 on Netflix anymore. You're at 293, and they announced a big jump in subscribers. But what I was told, a lot of those subscribers are not paying, meaning they go on for some kind of a deal. And if that's true, and those people don't convert. In fact, somebody told me that a lot of people, they come on with a trial subscription that they don't have to pay for, and then when it runs out, they go with another trial. So I don't know if that's true or not, but let me put it this way: it would throw a little wrench into the engine of the growth in the subscribers and users. So at any rate, it's down 20 points today, almost at 293. And again, it's on the defensive as well. That high valuation, you have got to keep moving your legs. Once you slow down at all, this car costs a lot of money based on its PE ratio. And, people obviously are not that excited about holding it if it's not going to have the growth that they think. Again, I think I'll give you another thing, because again, I've been doing this for a long time. My opinion on this as well. The Fed is normalizing interest rates, and I think the Fed funds is at 2.5, something like that, right? That's not a high rate. That's not going to kill an economy. That's ridiculous. What's happening here is they're normalizing interest rates, so they're going to be normalizing stock prices. And stock prices don't normally go up 20 or 30%. So obviously, and the growth of 3.5%, which we saw the GDP today, that is unsustainable if we're going to have higher interest rates and things are going to slow down. So people are saying that to themselves, and they're repricing stocks for a no free money anymore environment. Right now, you throw in there the tariffs, which is causing a lot of problems. It's supposed to help us, but the trade deficit is now at a record again. So the bite that the tariffs are doing, and this war with China, who can wait us out very easily because their elected officials are lifetime elected, where ours are turning over all the time. You're looking at a situation where the moderation in stock prices is meaning, we're going back to a more normalized environment. You can still make money in stocks, particularly selected issues, but you're going to have a situation where you're probably not going to get the robust gains that came after the tax cut, which obviously, if you lower the 10-foot rim to 6 feet, everyone's going to be dunking for a while, right? But then that wears off as well at some point. I will say this down here while we're down here, and people who are listening probably would like to have some idea of what might be some line in the sand, because I believe the line in the sand was 2690, and it was. But once it broke, you can see it's had a very difficult time. So 2690, which was the lows of June and July, 2690 area, that was support, and that was where I thought it would go, and it did go there, and it did bounce out of there. But it went right back through it because, again, the normalization process of the stock market is continuing. And so where's the next line in the sand would be the logical question, right? Well, here's where I think it is. It is at the yearly lows, which is 2530, to the first quarter's low high point, which was 2590. So I think the 2530 to 2590, if it holds, then I would turn my attention. Remember, I always tell you, you got to worry about where the puck's going, not where the puck is right now. So where do I think the puck could go? Well, let's look at this. You're discounting the heck out of the market in October, right? And you've got the Christmas season coming up. And the big thing you got coming up, there's two big things. Okay. One is you got a G20 meeting at the end of November where China and the US are going to get together. And maybe some of the Trump bravado might wear off now because, if he considers the stock market his report card, when you get F's, you got to, get that signed off by your parents too, right? I mean, he certainly owned the stock market on the way up, and I'm sure he's going to throw the Fed right under the bus on the way down. But he's also going to realize that his report card's got a lot of red on it now. So he may be a lot more humble. And that's not exactly a word you always use with the president, but he may be a lot more humble in that G20 meeting with China if he has one. And they may come out with something that, at least in language only, sounds better than where we are now. That's number one. Number two is the blackout period for corporate buybacks is going to be coming to an end here because, again, they generally do not buy stock back in the last 2 weeks of a quarter and until all the earnings are out. Well, why would that be? I don't know. I mean, I'm not saying this is a fact, but my opinion would probably be is they don't want to see front running, right? Say you work for a company, right? And you know what the numbers are, right? And so in the last 2 weeks of the quarter, they don't want you loading up on stock because you know that the numbers are going to be good. And then they don't want you loading up while the stock is announcing because that might have an effect on it as well. So it makes sense that in the last 2 weeks of a quarter and then until after the earnings are announced, generally you're not going to see a lot of corporate buybacks. Well, that period's going to be ending. And so in November and December, they're going to be able to buy their stock back. And if they have a ton of cash like Google does, maybe they would use that money at that time to support their stock and buy it at a big discount because it is getting a big discount right here. So if you wanted to know what I'd be thinking let's look at that 25.30 to 25.90 as a worst case scenario. As a trader, that would be your opinion. That would be your line in the sand. Of course, if it breaks that, you're going to get whacked. But if it doesn't, then that's the buy zone possibly. Now, what's going to make it go back up? Well, one is because it's oversold to the downside big time now. And two is because if China G20 goes well, and if the corporations start buying the heck out of their stock again, then of course the no buyer environment, the lack of liquidity that we're seeing today and during the week will go bye-bye. And then these things may get a bid. That would be my scenario. So you've got stocks you like, start looking at the S&P. If we get into that 25.30, 25.90 zone, you might start taking some bites down there. And then you obviously will be hoping that the news on G20 and the blackout period, when it gets lifted, see some liquidity and some good buying from the corporations of their own stock. Again, that would be a scenario. And I think right now it's not a bad looking scenario because, again, we've had a pretty good drop here. And again, the numbers are still good. These companies are still making money. They're just not making as much maybe as they hoped, or their revenue wasn't quite as high as they hoped, or they're not looking to make as much profit as they hoped, but they're still doing quite well. And the GDP at 3.5, while it may not be sustainable, it's still a strong number. And anything 2.5 to 3 would still be a pretty darn good economy. So don't throw the baby out with the bathwater here. But if you have powder that you've kept dry, I would suggest using those parameters as a place to start accumulating. If you're a believer, the G20 thing might go well. If you're a believer that the corporate buybacks will start happening again. If you don't, and you think that we're going into the abyss, obviously don't do anything like that. Okay, what else is going on out here that might be helpful to you as far as my opinion is concerned? Again, Amazon guiding down 5% possible for the Q4. Now, like I say, they may be saying 5% down and the thing could be robust. There's a lot of people say the consumer. See, let me look through this GDP report with you today. Tariffs took a big bite out of the U.S. Situation. Record trade gap and basically a little slowing down in the orders. We had a boost in inventories. That's why the GDP number popped up so much. Companies restocked, getting ready for this big Christmas season. So let's hope that the consumer goes out there and spends some money because obviously companies have restocked their shelves getting ready for them. And it did offset the drag on the trade numbers with regards to that. We're looking at consumer spending up 4%, but that is the best since 2014. So the consumer still looks like he's out there doing a great job as far as spending money is concerned. Saving rate did drop as well. So obviously they're saving less, and they seem to be spending quite a bit. With regards to government spending, we're always hearing about fiscal discipline and how this will pay for that and this will pay for that. Well, you can put that aside because government spending rose the most since 2016, up 3.3%. And I don't know who's planning on attacking us, but we're throwing a lot of money at defense, up 4.6% in defense spending. So I don't know if we're picking fights out there or if somebody is planning on doing something, but we're certainly going to be spending a ton of money getting ready for them. And, again, while healthcare, they're trying to take away healthcare and they're trying to take away Medicare, Medicaid, and Social Security cuts and everything else, where they're making sure that we got plenty of tanks and radar and sonar and everything else. And that's obviously a big debate. Inflation, rising material costs and freight costs were talked about with Caterpillar last week. So obviously there is some pricing pressure, and that's why the Fed is saying to themselves, come on, we're at 2% and change on the Fed funds, and that's going to halt the whole economy. I mean, go look at the history of interest rates. First of all, it was a joke to keep it at zero so long. If you were a saver, you were penalized for having saved your money and not gone in debt. And now we're going back to a more normalized environment. And certainly we're nowhere near normal at 2% or change on the Fed funds. So, I mean, I think you got to get used to having some type of a different rate there. Otherwise, you're going to create a world where everyone just prints money to buy their own debt, prints money to buy their own stock, and Lord knows where that ends. So the bottom line is that, I think the normalizing of interest rates makes a lot of sense. It also gives you a cushion just in case there is a slowdown, because you can't cut rates from 0 to 0, right? And basically that's what's happening as well. There's weakness in business investments right now. Basically, the IMF also has announced a little bit of a cut in global growth. Listen, this is all part of, we were way overbought, like on the Amazon example. You can't be at 2050 with your moving averages on the 200-day at 1550 and not have a pullback. It just isn't going to happen most times. Okay. And so basically you had an overvaluation, the CAPE ratio that is very popular to try to figure out what the value of stocks are. But it's called a cyclically adjusted price earnings ratio. Okay. It was co-created by that Yale professor, Robert Shiller. And basically, based on the average annual profit for the past decade. See, they're trying to smooth out the numbers a bit. Well, it showed a while back that the U.S. was the world's most expensive stock market. And basically, again, overvaluation was a big part of the drop here, not the Fed 2% interest or whatever the heck that is. Okay. So again, the stock market is a valuation thing. It's a bet on future earnings. And when you're buying equities, you're betting on future earnings. And obviously people are taking back some of their bet because they're thinking that the future earnings may not be quite as robust as they've been. And if we've had peak earnings, you don't have to be from Harvard to figure out that the stock prices may have a more difficult time rising if interest rates have peaked. I mean, if earnings have peaked. Okay. Some things are very complicated in life, but some things sometimes are not as complicated. And certainly the earnings slowdown would not be bullish for stock, right? Okay. And again, if you have any questions on hedging, how do I do married puts, or how do the collars work, where the out-of-the-money call pays for my put? Basically, the email address is OptionProfessor@gmail.com. And you simply shoot me an email. I'll be more than happy to give you a hand with the use and the risk of the strategy. Obviously, I'm not recommending anything to any particular person, but I am there to explain, like I used to do at my seminars, the use and the risk of the strategies. And Lord knows, these two strategies that I've been pounding the table on for the last 6 months so that you learn about it have come to roost in the last month. But at any rate, knowing how the tools work is much more important, because then it's a tool for life. And that's why I always suggest people give me an email and let me know what their questions are, and let me give them a hand, okay, on the understanding front. All right, let's see what else is happening here. Western Digital really got whacked because they guided down, and so they're in the abyss here. Some people were thinking that the that the biotechs might be an interesting look down here. Let's see if they're holding up at all today. Well, they're still holding that 100 mark, and that 100 mark is the line in the sand for them. So that's the F. And as you can see, it's right around the 52-week lows, right? So, if we can hold this 100 area, there could be value down here. So I would keep an eye on that. And, some of the companies don't have the worst valuations anymore. The big daddy there in the biotech is Amgen, right? So let's take a look at Amgen and see what it looks like. And everything's going to look bad because the markets have come down. The question is are they going to continue to look bad, or will there be some support? And again, on Amgen, you're at 185. Again, pretty similar to the IBB. And again, it looks like this 180 mark, might be an area where it could find some support. If it doesn't, then it doesn't. But again, it is discounted from 210 down to 180. Another company that people are looking at as far as a bellwether being on sale is Home Depot. And let's talk about Home Depot right now. Home Depot, just like everybody else, getting whacked hard down at 170. That used to be the area where it took off from, though. In fact, when I last was interested in Home Depot, it was at 170 because that used to be the 200-day moving average. After all that run up, the 200-day average is going to be above that now. But you can see this 170 mark is very important. 160 is the 52-week low. Okay, so some of these stocks that have not taken out their 52-week low, if we hold 2530 and we get good stuff out of the G20 and the corporations want to buy some stock, then this would be obviously one of the ones that I'd keep an eye on. Home Depot down here between 160 and 170. Microsoft, again, is another one that seems to have been able to hang in there pretty good. So if you're interested in tech, this might be a better one to look at than some of the others. Valuation seems to be a little bit better here. And of course, they're very big on this iCloud. And again, the 52-week low is at 80. Let's see where the 200-day moving average is real quick for you here and see if there's any. But I mean, again, when you get a discount like this, sometimes looking at the big names that are trading at a discount is not the worst ones to go with because they've got good businesses because of their earnings trends. Again, we're trading at 105. The 200-day average is at 100, and then your 52-week low is at 80. 80, I think, would be the worst case scenario, and I think that'd be quite a decent value down there. Providing the whole world isn't changing into a slow growth environment, which I don't think there's any evidence of that right now. Right now, I think there's evidence that you're having a overvaluation pullback and then a repricing of stock for the environment that we're going to be in, where the puck is going, which is a more moderate GDP and a more moderate earnings growth arc. Okay. And I think that's what's going on now, not the collapse of the US economy or anything crazy like that. There's no evidence of that. The evidence really to me is that you were way overbought and then you kicked it back down. Let's see if there's anything else out here. If you think China may be in a turning phase down here, the two that I've been watching is BABA. And that's Alibaba, and I'm looking at 135 to hold. And if it holds 135, I think that would be one to keep an eye on. So you got your 52-week low there, and you're trading at 141. So if they're going to have a good G20 meeting and things are going to thaw out a little bit, and we don't take out that 135 and we take out 150, then I think you might be onto something. Probably here, the best thing is to wait for it to get above 150. So then you're at least getting momentum. You don't want to be the first guy at the party unless you're the smartest guy in the room, and I'm not the smartest guy in the room. So the bottom line is if you got above 150, then you'd start turning the chart around. And if you start turning the chart around for a reason, like they had a good meeting at the G20, then you could be in a situation where it might not be bad to be into this because it's heavily discounted from 211 to 135, right? It's a pretty good discount. How about Baidu? Baidu right now is at 188. The 52-week low is 182. Again, this one seems to be under here because I think it made that, it made that 52-week low today. But look, it went $6 higher already off the low. So again, and this one here, you probably wouldn't mind getting it above 210 because it looks like some resistance there. Or if you think that this 180 area might hold and you think the news will get better, it could be a play to go from 180 towards 210, which I think that double bottom there might be some resistance. There is a gap there at 225, so it does get moving. Filling in that gap up at 225 is not off the table. But this is really going to be dependent upon the Chinese meeting, if they have one, on at the end of November, to be fairly reasonable. Intel is another big company out there that people think are going to be more stable if you're looking at the tech center. Second, and there you go. Intel's up $1.34 in a tape that looks like that. That might be telling you something. The low of the year is 42. You're trading at 45. So if you think that we will see a turn later in the year, once the possibility of corporate buybacks blackout period is lifted, and again the G20 meeting, then this might be something to keep an eye on as well. That's certainly an impressive move today in a down market that we've seen. So keep an eye on Intel as well. And McDonald's. People they got to eat those fast fooders here, I guess. And that's down a little bit, but again, it has held up a lot better than everything else. Look, the all-time high is 178. We dropped how many points on the Dow? And this thing's only 173. So obviously, people are still holding on to some of the consumer staples, and of course, McDonald's pretty steady there as well. There's a couple of other things I'd like to get to before we close out here today, and oh yeah, one was Snap. Snap is getting crushed by Instagram, big competitor, and they've got Google behind them. So that's one of the problems there. But a lot of people are thinking that there is something here, technology-wise, and they are thinking that somewhere in this 5 area, most of the bad news might be done on it. So I would monitor this and then probably use it as an option. In other words, when you pay $5 for something, you're really buying an option for $5, right? And then basically they're either going to go out of business or they're going to rebound. I mean, I've seen this happen time and time again, where you could get a company that has just been whacked down, 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 and you say, well, listen, I'll put up $5. And it's either going to go bankrupt and I'll lose my $5 like a call option, or it's going to rebound. The difference is you own that option until the company goes out of business or until it rebounds. And so that's a pretty long-term option potentially, unless they go get whacked out. If these guys have any, value, there are a lot of companies with a lot of money out there who could snap them up, and they could snap them up right now for a big discount of $5 and change per share. This thing came out at 21. So look at that, so that's one that if you're a believer in their technology and their product, which obviously people are not right now, but if you think they've got something there that could be, could be saved, then this would be the time to take a look. Okay, let's look at stuff like the dollar. And the dollar again went up towards 97. Again, that's the 52-week high. That's your dollar index. I was a believer that it could go a little bit higher here, and then the reality of all these deficits that are going to be coming, and the reality of a slower U.S. economy than was expected, could cause the dollar to roll over a little bit. Obviously, the interest rate differential between the U.S. and Europe and the U.S. and Asia is obviously helping the dollar tremendously. But at some point, if your deficits get big enough and your economy moderates a bit, some people may be selling something like this because of the deficits that could be happening. If the deficits are going to be big, and if inflation is going to be coming back, and interest rates are rising, well, they're going to be rising because they think inflation might be coming back, and that sets up the gold, which I've been talking to you about. The low on the gold miners ETF has been about $17 a share and is trading at 19. If this thing can start getting above 21, which you can see is some resistance, there could be some significant potential here. So keep an eye on this because a turn has occurred. The question is, will it get legs? And if the inflationary numbers pick up and the Fed continues to hike because of problems with inflation and stuff like that, then this thing could turn around and go from an out of favor sector to something where people are rotating money into, out of other things that are not working into this, which might start working. So keep an eye on your gold miners right now. Okay, and then let's look at interest rate finally, and then I'll sign off. Interest rates, 10-year note. I told you if you've been watching this show that once we got above 3, it could pop a little bit. That's exactly what it did, and it popped all the way up to 325. Now it's going back to where it broke out area. And that three area should be some pretty good support. And if this stock market stops dropping in the precipitous manner that it is, this thing may go back on its bicycle. Again, they're planning on a hike in December, and they didn't think the drop in the stocks was going to dissuade them, unless the drop in the stock ends up to be like 2,100 on the S&P, and then of course all bets are off. No evidence of that happening right now. These companies are still making very good profits. They just aren't making quite as much, and they're forecasting not as much. That doesn't mean they're losing money. It means they're making a lot of money, and the consumer is still out there spending. So I wouldn't get too negative here during this drop. And again, who's going to help us down the road? Possibly corporate buybacks after the black period, and also the G20 meeting. And of course, there is power of pricing in the system. Caterpillar says their material costs are rising and their freight costs. So there is something out there, and the Fed is obviously concerned about being at 2.5% on Fed funds if we're going to get a whack of inflation, because that's a very low rate if any inflationary numbers come in. Okay, that is this for today, October 26, 2018. Again, I'm Jim Kinney, and I do invite you to email me with any questions, any comments, and anything I might help you with. Again, it's option, OPTION, professor, PROFESSOR, @gmail.com. Until next Friday, good luck, good trading, and have a great weekend.